Now, surprising news to both of us. So when did this and how did this happen?
Well, this has been happening over really decades. I mean, these firms in Chicago started to set the stage for taking over trading in this $13 trillion treasury market back in the 90s when they started to use futures and options and other instruments as sort of a way to arbitrage markets quickly using high-frequency strategies. So the sort of computer-based algorithmic trading strategies really grew up in Chicago starting in the 1990s. And now you have these firms, Citadel, Jump Trading, Teza Technologies, that are all in Chicago and are accounting for, these Chicago high-frequency trading firms account for more than 60% of trading on the biggest treasury electronic trading platform out there. So, and this is according to risk.net, and this was just looking at a couple of the months this year. So this is a pretty dominant force in this incredibly important market.
So what are the broader implications of that? Why is it so significant that this is happening?
Well, first, it shows that the Treasury market is going electronic. And second, it raises the question of, do Wall Street regulators really have a handle of just how much this market has changed, and have they adopted tools to really be able to surveil it in an accurate and appropriate way? I think that last year, on October 15th, basically, the answer was no, right? I mean, I think pretty broadly, everybody was saying, look, we don't have a handle on what was going on, who was going on, where it was going on. I mean, that is a very alarming thing for this market. We cannot overstate the importance of the Treasury market, right? I mean, this sets the rates for, you know, mortgages, corporate bonds,
car loans, everything.
Car loans, and it also sort of sets the tone for the rest of the world. People look at this market to set cues for everything.
And so relative to treasuries.
And it makes like stocks look like puny compared to the amount that's traded in treasuries. So does it actually wind up affecting borrowing costs in the future?
Well, this is a question that people are looking for. They're trying to figure out, does it make the market more volatile, less volatile? The answer may be both, but really people just want to get a better handle on what
we're still trying to figure it out, I guess.
I'm sure big banks too are like, I got to get my business back.